All right, so let's dive into the Indian stock market. Imagine it's March 2025, and you're thinking about maybe making some investments. Should you jump in? Should you maybe hold back? Well, we've got this newsletter from Volatility Coaches of India. It's dated March 9th, 2025, and it's got a lot of data recommendations and all that good stuff. So we're going to unpack it and see what it means for you.
Sounds good. This newsletter is dense for sure, but I think there's some really good insights in here for the listener.
For sure. For example, they mention the Nifty Y50 closing at 22,552.50 on March 9th, and it's down just a bit from the previous week, which makes you think, is this a good time to buy, or is this the beginning of a downward trend?
That is the question, and the newsletter gives us some clues. You always want to look at the PE ratio. It's 20.05, and that kind of gives you an idea of whether the market thinks future earnings justify the current price.
So is that high or low, 20.05? What's the context?
Well, it's definitely something to think about along with other indicators in the newsletter. It mentions the market cap to GDP ratio for India, 111.7%. And generally when that ratio goes above 100%, it can be a sign that the market might be getting a little too expensive.
Okay, so maybe be a little cautious, but then they throw out this figure, FII, net open interest change, negative 3,955 CR, and I'll be honest, I have no idea what that means.
Yeah, it's a little bit jargony. Basically,
Yeah.
it means that foreign institutional investors, the big players, have been selling off Indian stocks, and that's definitely a factor in the overall sentiment.
So we've got the Nifty Y dipping a little bit, maybe a high market cap to GDP, and the FIIs are selling things off, not looking so good, right? But then they mentioned the India VIX at 13.47, which seems pretty low. Does that contradict all the other stuff?
Not really, no. The VIX measures market volatility, so a low number like that suggests that investors aren't expecting any big swings right now, even with all those other factors.
Interesting. So mixed signal, I guess, but then they bring up this Buffett indicator, and not just once, but twice they calculate it using the original model, and then again with a modified version. What's that all about, and what does it tell us about the Indian market?
The Buffett indicator is a fascinating tool, but it's definitely not a crystal ball. It compares the country's total stock market value to its GDP, and in this case, both calculations point to a 6.2% annual return for the Indian market.
6.2%. That's not so bad, but what exactly goes into those models? They mention economic growth and dividend yield and some other things.
Right. It's not just a simple ratio. The original model looks at economic growth and local currency, dividend yield, and this concept called valuation reversion to the mean, which means that over time, stock prices tend to go back to their historical average.
Oh, so it's like trying to predict the future, but also considering the past. And what about the modified model? What's different about that one?
Right. It keeps the economic growth and dividend yield the same, but adjusts the valuation reversion to the mean a little bit. And what's interesting is that even with the tweak, it still comes up with that 6.2% return.
Two different approaches, same result. That's got to give investors some confidence, right?
It's definitely a data point worth considering, but like any model, the Buffett indicator has its limitations. It's just one piece of the puzzle. You don't want to base all your decisions on it.
Of course, we can't forget about all the real-world stuff, company performance, risk tolerance, but it's definitely something to think about. And this newsletter goes on to make some specific recommendations. For instance, it says, below 22,000 NIFTY levels, buy more equity in a staggered manner and include multi-asset strategy. And that phrase staggered manner really got my attention. What does that mean exactly?
It's a pretty smart strategy, actually. Instead of putting all your money in at once, you spread out your purchases over time. That way you're averaging out your entry price. And it reduces the impact of those sudden market swings.
Oh, so it's a more careful approach. And what about the multi-asset strategy?
It's all about diversification. Basically, don't put all your eggs in one basket. Spread your investments across different things, bonds, real estate, even commodities. So if one investment isn't doing well, others might be doing better, and that protects your overall portfolio.
Okay, so buy, slowly diversify. Don't put all your money in one place. Good advice for sure, especially with all the mixed signals we've seen so far. But then the newsletter says, the lower we go, convert flexi-cap to multi-cap funds. I need a refresher on those. What are they and why would we switch between them?
Good question. Flexi-cap funds are more flexible. They can invest in large, mid, and small cap stocks. So the fund manager has more options multi-cap funds have to keep a certain percentage of their investments in each market cap.
So it's about adjusting your exposure as the market moves. Why would you switch from flexi-cap to multi-cap when the market goes down?
Well, think about it this way. When the market drops, smaller companies get hit harder than the big ones. So switching to a multi-cap fund could be a way to make sure you still have some exposure to those smaller companies, but with the stability of those large cap investments as well.
Interesting. It's a balancing act, but they don't stop there. They also mention a current focus on large cap funds and hybrid funds. What are those and why are they important right now?
Large cap funds focus on the big companies. They tend to be less volatile than smaller companies, so they're usually more resistant to market downturns.
So playing it safe in uncertain times and hybrid funds, I've heard that term before, but I can't quite remember what it means.
Hybrid funds are a mix of stocks and bonds. So you get a blend of growth potential from stocks and income from bonds,
Yeah.
which can be good if you're not sure which way the market is going to go.
So not all in on stocks, but not completely conservative either, makes sense, but it doesn't stop there. They even list specific sectors: current sector focus, banking, finance, IT, and pharma.
Those are sectors that are often seen as indicators of the overall Indian economy. Banking and finance benefit from overall economic growth. IT is a global powerhouse, and pharma tends to do well even when times are tough.
It's like they're saying, if you're going to invest, these are the areas to keep an eye on. This newsletter also has this interesting section called Notes and Observations. It looks back at market trends over the past few years and mentions something called the 13 EMA. That sounds like we're about to get technical.
We are, but in a good way. The 13 EMA, or the 13-day exponential moving average, helps us cut through the noise of daily price changes and see the bigger trend. It tells us if the market is moving up, down, or sideways over time.
So instead of focusing on all the ups and downs each day, we look for the overall direction and what kind of trends is this newsletter talking about. They mentioned dates and sentiment shifts.
Yeah, it's kind of like a market diary. They're pointing out key dates and events that cause changes in sentiment. For example, they mention a negative trend starting on January 23rd, 2022, when the Nifty Y closed below its 13 EMA. Then on March 17th, 2022, it closed above its 13 EMA, which suggests a positive trend was starting.
So the 13 EMA is like a signal that tells us about possible turning points in the market: bearish when the Nifty Y closes below it, bullish when it closes above it. But how do we connect those trends in the past to what's happening now?
That's the key question. It's not about predicting the future exactly, but understanding how the market has reacted to different things in the past gives us clues about how it might react in the future.
Right, because history might not repeat itself exactly, but it can give us some hints. So by studying those past trends, we can get a better idea of what to look for now. But this newsletter also talks about the performance of Nifty Y Small Cap 100 and Nifty Y Mid Cap 150. They say that they remain positive. What's the takeaway from that, and what does it mean for investors who are thinking about these segments of the market?
Well, small cap and mid cap stocks can be more volatile,
Yeah.
but they can also have bigger rewards. The fact that those indices are staying positive suggests that investors are still willing to take some risks to get those higher returns, even though the market is a bit uncertain.
So it's like a sign of confidence in the growth potential of smaller companies, even with those mixed signals in the overall market.
Exactly. But it also shows how important it is to understand your own tolerance for risk. Are you comfortable with a higher level of risk and the possibility of bigger changes in your portfolio? If so, then small and mid-cap stocks might be worth looking into.
Great point. Risk and reward go together, and you have to know what you're comfortable with. Before we wrap up this part of our deep dive, let's take a quick look at the sectorial index table. It breaks down the performance of different sectors in the Indian market and gives us a very detailed view. What are some things that stand out to you in this table?
It's amazing how this detailed data can help us understand those broader market trends. Remember how the Nifty Y50 was down just a little bit? Well, this table shows us that some sectors like IT and pharma are actually doing quite well.
Interesting. So even though the overall market might be going down a little bit, some sectors are doing the opposite. That's really helpful for investors who are looking for good opportunities. But we're running out of time for part one. Join us for part two, where we'll continue to go through this newsletter and find even more insights about the Indian stock market. So we were looking at the sectorial index table last time, and it gives us a breakdown of how different sectors are doing in the Indian market.
It does. And you remember those high PE ratios we saw in IT and pharma?
Yeah.
Well, that means investors are feeling pretty good about future earnings in those sectors, even with the Nifty Y50 dipping a bit overall.
Yeah, it shows why it's important to look beyond just the headlines and understand what's going on in different industries. I mean, what might seem like a negative trend could actually mean there's growth happening in other areas.
For sure, this table gives us an idea of which parts of the Indian economy are doing well, even if the overall market is a little uncertain. And having this information helps you make better choices.
Now, I want to go back to the notes and observations section. This is where the newsletter really gets into those market trends over the last few years. They've got dates, events, and even categorized market sentiment. And I noticed they use the 13 EMA to track those changes. Can you explain how that works?
Of course, the 13 EMA, or the 13-day exponential moving average, it helps us see the big picture. Instead of getting distracted by those daily ups and downs, the 13 EMA smooths out the price data over 13 days and shows us the underlying trend.
So it's like a tool that helps us see if the market is generally moving up or down, even if there are some bumps along the way.
Exactly. And the newsletter gives some specific examples. On January 23rd, 2022, the NFDY closed below its 13 EMA, which indicates a negative trend. Then on March 17th, 2022, it closed above its 13 EMA, which suggests a positive trend was starting.
So the 13 EMA is like a signal that might tell investors about possible turning points in the market, bearish when the Nifty week closes below it, bullish when it closes above it. But how do we connect those past trends, those signals, to what's going on in the market right now?
That's the question, isn't it? It's not about predicting the future exactly, but when we understand how the market has reacted to certain events in the past, we can get a better sense of how it might react to similar things in the future.
Yeah, it's like having a map of past market behavior that can help us navigate the present, even though there might be some unexpected turns along the way. Now, this newsletter also talks about the performance of Nifty Small Cap 100 and Nifty Mid Cap 150, and they say they remain positive. What are your thoughts on that?
It's interesting, right? Because despite some of those cautionary signals we talked about, they're pretty optimistic about small and mid-cap stocks. And remember, those are typically considered a bit riskier, but they also offer the potential for higher returns compared to the larger companies.
It seems kind of like a mixed message. On one hand, we've got these warning signs, and on the other hand, they're saying there's still opportunity in those potentially more volatile segments.
It's all about risk and reward. If you're okay with a higher level of risk and you're looking for bigger returns, then small and mid-cap stocks might be worth considering. But if you prefer stability and you're not as comfortable with big changes, then sticking with large cap companies or diversifying across different types of investments might be a better way to go.
It makes sense. It all comes down to knowing what your goals are and how much risk you can handle. So the newsletter recommends that investors buy more equity below 22,000 Nifty levels in a staggered manner and include multi-asset strategy. Can you break that down for someone who's thinking about investing in the Indian stock market?
Sure. Buying equity in a staggered manner basically means you spread out your purchases over time instead of investing all your money at once. And this helps to reduce risk by averaging out your purchase price and making those short-term market changes less impactful.
So it's like testing the waters before you jump in, a more cautious approach because of that potential for volatility.
Exactly. And the recommendation to include a multi-asset strategy also points to that cautious approach.
Yeah.
Remember, multi-asset strategy means diversifying your portfolio. So you're not putting all your eggs in one basket, even if one part of your portfolio takes a hit. Other parts might be doing well, which helps to protect you overall.
Like building a safety net, spreading the risk, and maybe getting better returns in the long run. So they also say to convert flexi-cap funds to multi-cap funds the lower we go. Can you remind us what those are and why that switch might be a good idea in a declining market?
Of course, flexi-cap funds are more flexible. The fund manager can invest across different sizes of companies, large, mid, and small cap stocks, and they can adjust the portfolio based on what the market is doing. Multi-cap funds have to stick to a certain percentage of their investments in each market cap segment. So shifting from flexi-cap to multi-cap when the market is dropping could be a way to make sure you still have some exposure to those smaller companies, but with the added stability of the large cap portion as well.
So it's all about finding that balance between flexibility and stability, especially when things are uncertain in the market. The newsletter also highlighted a current focus on large cap funds and hybrid funds. What's the reason for putting the spotlight on those specific types of funds?
Well, large cap funds, as the name suggests, they invest mostly in the big, well-established companies, those blue chip companies. They're generally considered to be less volatile and more likely to weather those market downturns. So they're a good option when things are uncertain.
So a safe haven when the market is stormy.
Exactly. And hybrid funds, they offer a mix of stocks and bonds. So you get some growth potential from stocks and some income from bonds, which can be a good option for investors who want a moderate approach, not too risky, not too conservative.
A little bit of both worlds, but they go even further and highlight specific sectors: banking, finance, IT, and pharma. Why that specific advice?
These sectors are often seen as the drivers of the Indian economy. Banking and finance do well when the economy is growing. IT is a global powerhouse, and pharma, especially in uncertain times, tends to be pretty resilient.
So they're basically saying these sectors are the engines of the Indian economy, and even with some ups and downs, they have a history of doing well. But there's one more thing we need to talk about before we move on to part 3. We've been through a lot in this deep dive into the Indian stock market. We've talked about market indicators, investment recommendations, historical trends, and sector-specific insights. But let's try to sum it all up. What are some of the big takeaways for our listener, and what should they keep in mind as they try to figure out this complicated market?
Well, the Indian stock market, it's just like any other market. It's got opportunities and uncertainties. We've seen some signs that maybe we should be cautious, but there are also some good things, especially in certain sectors. This newsletter, it's a good place to start, but it's really important to think critically and do your own research.
I agree. This deep dive is all about giving you the knowledge, not telling you what to do with your money. But speaking of that, what are some questions our listeners should be asking themselves as they think about all this information?
Always start with, what are my goals? Are you looking for long-term growth, or are you trying to make some quick gains? Because how you invest is going to depend on what you want to achieve.
Right. It's like knowing where you want to go before you start your trip. You need a destination.
Exactly. Once you know your goals, then you need to think about risk. How much are you comfortable with? Are you okay with your investments going down a bit in the short term, or do you need something more stable?
That's so important. Some people are okay with risk and others want to feel secure.
Mm.
It's all about knowing yourself and choosing a path that fits your personality and your financial situation.
For sure. And once you've thought about your goals and how much risk you can handle,
Yeah.
then you can start to think about your investment strategy. Will you focus on individual stocks, or are you more comfortable with mutual funds or ETFs? There's so many options.
It can be overwhelming. That's why research is so important. Take your time, understand the different investment options, and see which ones fit your plan.
Exactly. And don't forget about diversification. Don't put all your money in one place. Spread it out across different asset classes, sectors, and even different parts of the world that can help you manage risk and maybe get better returns over time.
It's about balance, right? Not putting all your eggs in one basket. So this newsletter gives us a snapshot of the Indian market as of March 9th, 2025. But we all know things change all the time. How can investors stay up to date and change their strategies as the market changes?
You're right. Investing isn't something you can just set and forget. You have to stay informed about economic trends, industry news, and what's happening with specific companies. Keep learning. Be curious, and don't be afraid to change your plan when you need to.
So it's a journey, right? You're always learning and adapting. And if you're ever not sure about something, talking to a financial advisor is always a good idea. They can give you personalized advice and help you create a plan that works for you.
Definitely. They can be really helpful, especially if you're new to investing or if you're dealing with some complicated financial stuff.
We've covered so much in this deep dive, from market indicators and investment recommendations to historical trends and sector-specific insights. But now it's your turn, our listener, to take all this knowledge and use it to make your own investment decisions.
It's been a great discussion, and I encourage everyone to keep researching, stay curious, and keep learning. The world of investing is always changing, and there's always something new to find out.
I'm feeling a lot more confident about the Indian stock market after all this. We've gone through some complicated ideas, but hopefully we've given you the tools to think for yourself and make smart choices. Until next time, happy investing.